I would just like to discuss the recent acquisition and the purchase of a lot of shares by Charlie Munger, who's the BFF of Warren Buffett. Both of them has been portrayed as the investment genius of our times, and even up to when they're currently around 90 plus years old, they're still very vocal in their investment philosophy and very open in sharing how and recommending how people should go about investing in the current stock market. And basically, Charlie Munger has essentially loaded up a boatload amount of Alibaba shares. For those of you who do not know what company Alibaba is, but I highly doubt so, it's essentially an e-commerce platform, and a lot of them have been comparing Alibaba as the likes of Amazon of China. So they have a very huge global footprint, but majority of their revenue is still derived from all the China market share, and they've been dominating the entire e-commerce space, especially in Asia, with all their subsidiary. So it's just my own primary or preliminary understanding of comparing Asian shares and Asian companies versus America. So especially like companies in Singapore, for example, and in China, huge companies or huge conglomerates usually have a hugely diversified portfolio. They will have their arms and legs all over the place. So for example, Tencent and even Alibaba, they have their arms in the cloud industry, they have arms in e-commerce, they have arms in gaming, they have arms in essentially everything. They want to have a share, or they want to eat the pie of every single type of industry. And this also it does reap diversification benefits because they wouldn't be over reliant on one single industry, but that also means that as investors, we have to put in a lot more work and a lot more research in really truly understanding what are the key drivers and revenue drivers of the company, which makes it a lot more complicated and a lot more hard to truly understand the fundamentals of the company compared to big companies like in America, especially in the US, where you have like Amazon, Google, Facebook. Off the top of your head, you know that Facebook is a social media company, albeit they might do like all the different projects that they are doing, like what's that thing called? I've forgotten already. Basically the eye specs goggle thing. Yeah, I've forgotten about it. Then next, Apple, you know, it's a hardware and software company. Google, it's just on their search engine. Amazon is in e-commerce and maybe a little bit of cloud. So as you can see, right, just a very simple comparison. America or US companies, they have a very key focus. Although they might do it simple diversifications of maybe just a few key infrastructure or a few key different revenue drivers, but for Chinese companies or even in Asia companies, they usually have a huge and wide-ranging portfolio to the extent where if you go about talking about the company or the key revenue drivers, you can go on talking about days. So with that, now let's go back to the main topic where why Charlie Munger recently loaded up on a lot of shares in Alibaba in his own portfolio that he's managing. So from what I understand, or from how I understood Charlie Munger and Warren Buffett, they have a very interesting key and investment philosophy, which is they rather buy wonderful companies at fair value than fair companies at a wonderful price. So what it means is whenever they do a purchase, they always require a huge margin of safety. So they will do their own analysis and they'll do their own calculations and postulation on how much the company will grow and how much or what is the intrinsic value of the company. And even after getting the intrinsic value, if the company is currently trading at that price, they are not happy with it. They will want a huge discount in order to term it as a margin of safety. So even if the intrinsic value of the company, for example, is worth $100, they will only buy it at, I don't know, $60, $70 in order for them to have that buffer in case anything happens. So this is their main main investment philosophy. And on top of that, the company has to be a great company, which is they will have to have wonderful growth rate, huge prospects, and really interesting future in order for them to even consider the company. So that said, why did Charlie Munger even go ahead and purchase Alibaba? To be honest, if you were to compare Alibaba to Amazon, because a lot of people online and especially in investing forum has been comparing them to the Amazon of China. from my own understanding and from my own analysis, I don't think that they are operating in the e-commerce space, but their business model is a little bit different from Amazon. To me, I think JD.com, Jingdong, is a lot more closer to Amazon's business model. Alibaba is just a spin-off Amazon, what Amazon is currently doing. So we can't really compare that to them. However, that said, Alibaba is still considered a huge tech company because they are also in the cloud space, they are in the e-commerce space, they are also now even trying to do a lot of branching out into a lot of different segments and industries. So if you were to compare just normal benchmarking and criteria like price to earnings and all the price to sales, Alibaba is significantly underpriced and undervalued compared to all the big tech companies and big tech stocks in the US. So I don't have my laptop with me now, I don't have the numbers, but off the top of my head, if I remember correctly, a lot of the big tech has been trading at like a 30 price to earning, and a lot of all the different metrics would deem them as overvalued. But Alibaba is currently only trading at a forward price to earning of around 19 or 18, which and price to sales of I think around 5 or 6, which would signal to investors that it is a huge discount. But we have to remember that Alibaba is still a Chinese company, and there is a huge political risk that is associated with this company, and you have to pay this I wouldn't call it premium, but it's more of like you have to take into account this political risk and this huge discount factor when you're pricing in the stock price of Alibaba. So even though I think a lot of us know that Alibaba is experiencing great growth, their growth story and their future prospects still looks very promising, but a lot of American investors are pretty afraid of how the Chinese and the US relationship, how maybe even the Chinese Communist Party might just take over the entire business and then let all the shareholders suck them and just get out of the company and stuff like that. So there are a lot of potential and real concerns behind the company, which also suggests why it's trading at such a huge discount. And I think maybe to Charlie Munger, when he loaded up on that share, he already took into account the political risk and the issues that are surrounding the company themselves. And he thinks that it might be overbitten, like the price is too much of a discount, and that's why he believes that he believes that there is still huge growth prospects for Alibaba. I will probably release another video where I deep dive into Alibaba's core businesses and maybe just discuss about his diversified portfolio. But that will probably be a very long video to talk about his entire business and to understand it fundamentally. But that's it. Just to wrap up in this entire video itself, there's a disclaimer. I do hold a huge position in Alibaba. It's around 20 to 25% of my portfolio currently. So a lot of maybe other friends might ask me, hey, are you not afraid that there might be real repercussions? Honestly speaking, I do understand the political risks that are involved, and it's a very dynamic situation between especially in politics. But moving forward, I think as a fellow investor in Alibaba shares, I believe that there's still huge growth prospects, and the political risk has already been accounted for, and it's over accounted for in the price itself. And in case where there's a real instance where there is a fallout between the two countries and maybe the CCP is taking over the company as a whole, it's really a very small probability, and if you're really afraid, then you can actually just trade the Hong Kong shares rather than just buy the US counterpart, because the US share itself is a shell company. You can straight away invest in the company in Alibaba with another brokerage in the Hong Kong Stock Exchange. So with that, I think that there is still more to meet the eye when Charlie Munger bought into Alibaba, and I think I would just like to emphasize that Charlie Munger is not the only investor, or it's not the only high-profile investor that's invested. I think even Bridgewater Ray Dalio is also invested in a lot of all these Chinese companies like Tencent, Alibaba, and since all this smart money is currently all residing into where they think is the next movement or the next biggest growth in the entire world, then I believe we do need to pay a little bit more attention in where the next growth or where the next trajectory is going in the world. And I do want to put my bet in where China is currently growing, and not be too afraid of this so-called problems and issues. Not discounting the fact that you have done your own research, and if it doesn't play out, and if Mr. C or President C really wants to do what he wants to do, then we can't help it anyway, right? So with that, I'll see you next week. Goodbye.